Over the past 3 years, the S&P 500 has nearly doubled in value. That's one of the strongest rallies we've seen in decades, and even today the market is still sitting near all-time highs. But when we step back and measure stocks against gold, US stocks have actually lost more than 30% of their value, and they're now trading below levels seen during the COVID recession. In other words, while stocks look strong on the surface, gold has quietly outperformed them, and that almost never happens. In fact, this setup has only appeared twice in modern history, once in the early 1970s, and again between 2006 to 2008. In both periods, stock investors were still enjoying all-time highs, but gold was already sending hints of warning by outperforming them even as optimism remained high. And in both cases, the warning proved to be right. The economy eventually slid into a deep recession, and the stock market fell by more than 50%. The relationship between gold and stocks is one of the most important in financial markets. Stocks are generally seen as risk assets. Gold, on the other hand, is typically treated as a safe haven. So when this stocks to gold ratio is rising, it usually tells us investors are optimistic about economic growth and productivity, and they're allocating more capital towards stocks. That's why we tend to see this ratio climb during long bull markets like in the 1990s and throughout much of the 2010s. When the ratio falls, the message is usually the opposite. Capital starts moving out of stocks and into gold as investors become more cautious. And historically, that's why this ratio tends to decline during periods of economic stress and market stagnation, such as the 1970s and the early 2000s. But since 2024, the relationship is breaking down. Stocks have remained strong, yet gold has outperformed at the same time. This divergence sends mixed signals and could suggest that the macro backdrop may be starting to shift. One explanation investors often turn to is inflation. Gold tends to outperform when inflation is out of control or when investors expect it to rise. And if we go back to the 1970s, we can see that this was clearly the case. Inflation surged from around 3% to nearly 15%. During that decade, the price of gold rose by more than 15 times. We saw a similar dynamic in the 2000s. As inflation climbed from roughly 1% to over 5%, gold prices tripled. And this makes sense. Gold has a limited supply, which is why it's often viewed as a hedge against rising prices. But today the picture looks very different. Inflation has fallen sharply from its 2022 peak. The latest reading sits around 2.7%, and many forecasts still expect inflation to continue moderating through 2026. That backdrop helps explain why stocks have been pushing toward a new all-time highs. And yet, despite inflation coming down, gold has still nearly doubled in value. So if inflation isn't the explanation, then gold's outperformance today may be pointing to something else entirely. And many analysts argue it could be something potentially more serious. This chart still shows the price of gold, but this time we overlay it with US government debt to GDP. And as we can see, the correlation is crystal clear. What this chart is really showing is that gold is reacting to government finances. Right now, US government debt is about 1.2 times larger than the size of the economy, and it's expected to grow even larger over the coming decade. And importantly, this isn't just a US issue. Countries like China and the UK are also carrying debt levels near the highest we've seen in decades. And then there's Japan, where government debt is now more than twice the size of the economy. So this isn't a localized problem, it's a global one. This matters because when government finances deteriorate across the world, a different kind of risk starts to surface. Not inflation, but its mirror image, currency debasement. See, when government debt climbs well beyond the size of the economy, investors naturally begin to question whether that debt can realistically be paid back. And when that debt grows, historically, there's one path that's been used again and again to get out of the debt crisis. Governments lean on central banks to create money and use it to absorb that debt. We've already started to see this. The Federal Reserve has resumed buying roughly $40 billion worth of US treasuries per month. And China's central bank has also restarted purchases of sovereign debt. If this money printing continues, it can provide short-term relief. It injects liquidity into the system, supports financial markets, and can even stabilize growth, which explains why stocks have been pushing to all-time highs and why they can continue to rise as long as inflation remains relatively contained. At the same time, gold can continue to outperform. As more fiat money is created, the purchasing power of that money gradually erodes. And in response, investors begin looking for assets that can't be printed like gold. And it's entirely possible for both gold and stocks to keep rising together, not because everything is booming, but because the currency used to price those assets is slowly losing purchasing power. Where this becomes more important to watch is if inflation were to re-accelerate from here. Historically, that's when gold's strength has tended to act as an early signal for equities, as we saw in the 1970s and in the period leading up to 2007. That doesn't mean we're heading there now, but it does mean this relationship is worth monitoring closely as the cycle continues to evolve. At Capital.com, we'll continue tracking important important intermarket relationships and the macro forces shaping the economy and financial markets. Hit like and subscribe to stay tuned. Thanks for watching.